thank you all for coming today. I'm Barry Starr. I'm head of Wall Street Horizon. It's wonderful to see all of you out there today, even if only virtually. We've got a great program set up for you. For those of you who don't know, Wall Street Horizon is the gold standard for curating extremely accurate forward-looking corporate events data so you can make and not lose money. We support institutional clients with an edge for your investing and trading needs, and we appreciate your being here today. This is now our third Data Minds event, which we're happy to host to help you gain access to some of the best independent minds in the field. So listen today, sign up for one of the one-on-ones, and talk to anyone here to make an introduction or to get your specific questions answered. Now, on to our program. Let me introduce you to our moderator for the session, Christine Short. Christine is our Vice President of Research, coming to us from Estimize, and before that, both S&P and Thomson Reuters. With over 15 years in the financial data industry, her research has been regularly featured in financial news outlets such as CNBC and Fox to talk about corporate earnings, the economy, and of course, corporate events. I hope you will learn as much as I hope to. Christine, the Zoom floor is yours.
Thank you, Barry. Thank you for keeping it to 60 seconds like I asked. And good morning, everyone. Welcome to this Data Minds panel. Like Barry mentioned, it's the third in this series. First time we're doing a panel, though, and the theme of today's event is called Incorporating the New Wave of Data Disruptors into Your Investing Strategy. And so, as you can see, we have a great lineup of alt data, all-stars, I like to call them, that are ready to answer any of your questions. Just a little bit on the program. We're going to do this 30-minute panel now. There will be no Q&A at the end, but we do encourage you, like Barry said, to sign up for one-on-ones. They are available today and tomorrow. You'll be getting a link to sign up through their Calendly. And so without further ado, just quickly, this is an alt data panel. I'm sure we've all joined these before. We're not trying to reinvent the wheel here. The goal really is just to keep the conversation going and give more of a state of the union on where we are in the alt data world. And so we have some great experts with us to do so. And without further ado, let me intro everyone. I think everyone can see their names, but if you could just give a little wave as I go around here. I'm going to start with Chris Petrescu, founder of CP Capital, which endeavors to bring data strategy as a service to the financial world. He was previously head of data strategy at Exodus Point, where he managed global data sourcing and strategic enterprise data efforts for both quantitative and discretionary teams across all asset classes. He was also a data strategist at WorldQuant and is a frequent speaker at industry events like this one. Next, we have Elizabeth Pritchard, serial innovator, data and analytics-driven executive with over 25 years experience in data and finance. Prior to founding White Rock Data Solutions, she held C-suite positions at Goldman Sachs, AIG, and Crux Informatics. Elizabeth is advising the Alternative Data Council of the Financial Information Systems Division of the SIIA on go-to-market for industry-wide alternative data, and she's a member of the board of directors for Eagle Alpha. Next, we have Marco Congraga. He's the head of quantitative research for the Americas at Ravenpack. He focuses on exploring novel approaches and techniques for combining fundamental drivers with big data quantitative frameworks to identify alpha opportunities from a wide universe of securities across multiple asset classes. As the head trader at an event-driven hedge fund in New York, he utilized quantitative methods in portfolio construction, developing hedging strategies, and trading structured derivative instruments. Next, we have Roberto Jedrich, previously Director of Market Data Strategy at Credit Suisse Asset Management and held similar positions at Schoenfeld and Millennium Partners. As a data analyst on the buy and sell side, he maintained a focus on alternative data. Roberto sits on several boards, including Battlefin. And then last but not least, we have Kevin Nichols, head of derived market data and analytics on CBOE's Data and Access Solutions team. He's focused on simplifying a complex marketplace, making the value-added information from the options market both digestible and relatable. Formerly a lead market maker for the proprietary trading division of Interactive Brokers, he co-founded Thales LLC, an options market making and prop trading firm in 2006, prior to joining LiveVol, which was acquired by CBOE in 2015. So I'm just going to jump right into it here, sort of at the beginning. Both seasoned data professionals that have been incorporating data for a while, and those that are just getting started, I feel like have the same question about how do I find data? How do I vet it? How do I make sure I'm not wasting time? You know, we always hear this number. There's 2.5 quintillion bytes of data being created every day. We have all sorts of new entrants on the market, companies that have never sold into finance before, whether they're marketing analytics or e-commerce platforms. They've got 4 to 5 years of data. They're looking to monetize that data now. So it's great. There's an abundance of information, but it can certainly be overwhelming. So Chris, I'm going to throw this first one to you and just ask, how do you direct clients who are looking for data, trying not to waste time, and how do you, have them not be overwhelmed by that process?
Sure. Thanks, Christine. Great question. I think for myself, my biggest piece is to have a focus. That's number one. There's a lot of people who ask me, what's the coolest data set? What data set has the most alpha? And those are, respectfully rookie kind of questions. I think for myself, I'm always asking my clients, which data sets and which key categories are best suited to fill blind spots in your investment process. And I can give a couple of examples on that, but I think that is a much better way to focus, whether you're a new firm or even an existing firm who might want to be beefing up in a certain area. So I'll give a couple of polar examples. A more traditional one could be ETF data. So if you had your risk team wanted to see what's my concentration of Apple across my whole portfolio, if you didn't have the ETF constituents, you wouldn't have any clue whether or not you had Apple as a stock or Apple in a tech ETF or something like that. So that's more of a risk compliance profile. You need ETF data. There are a dozen ETF firms on the market. There are 3 that I think are worth speaking to, right? So, and I can touch upon that later on. And second is, for example, a huge blind spot, which continues to be so, is all the social media data around Wall Street bets. So there's once again, bunch of firms who are claiming to have information on it, a handful of firms who actually have a product that is useful. And that really goes on to my next question is my next area is around hiring experts. You need people who have walked the walk before, whether they're somebody from an existing buy-side shop or my own pitch, a consulting firm like mine, people who have used all these data sets and gone through the pain of failing at, and this is something that Roberto can touch upon as well, of like failing and not being able to use certain data sets and where data sets have shortcomings. That's really the way to cut through the noise. So to sum up, it's first is have a focus on a couple of data sets within that sector. Don't try to boil the ocean. You don't need to. And next is to really hire experts. And when I mean experts, I mean people like, Elizabeth, Roberto, myself on the panel who have walked the walk. We're not these big new data Eagle Alpha type of enterprises that just have a big list, right? A list has no value if you don't have the context around it. And that's what people like myself can provide. So those are my 2 points on that.
Yeah, and those are great points. And, he mentions you, Roberto, and you've worked with a lot of data sets. What would you tell someone that's just starting the process of scouting and sourcing data? How would you lead them through that process?
So, I've worked for many buy-side firms, Millennium, Schoenfeld, QT Fund over at Credit Suisse. And, what's alpha to someone is garbage to somebody else. So it's all about hiring experts. My pain point at Credit Suisse, the QT Fund, was, I came in there with certain data sets, which I knew had alpha from my previous roles at the other firms. And I knew had significant alpha for many reasons, client retention, the revisions, they're just everything that, happens within alternative data and where they get the data. So what's happening at QT was the experts, data scientists, which is used very loosely, right? A data scientist, everybody's a data scientist these days, right? But a lot of them aren't, and they weren't finding alpha in the data sets that I knew had significant alpha. So it's about hiring experts. And these are all, Stanford, Yale, Harvard, University of whatever. I'm a Baruch guy, City University of New York, and I find more alpha in data than some of these other, professionals do. So it's really, it was frustrating for me because it all came down on me, like, Roberto, well, you said this data set has this alpha. It's garbage, it has nothing. And, long story short, QT's not in business anymore. We shut down right after COVID for lack of returns, lack of professionals, I would say.
I think one point on that I'd add is that you will fail in looking at alternative data. The best firms hire the brightest people, and they still buy 50% or less of the data sets. So I think going into the data question with your eyes wide open, knowing that your success rate will inherently be low, right? The more data that you invest in, the higher the bar is for that 100th, 101st data set. So it's okay to not buy everything you look at. And I think that's really just part of the process, part of the journey that you need to account for. And your best line of defense is to essentially kind of fail quickly each time, be able to screen out those data sets, like Roberto said, that they might not be point in time or they might not have enough coverage. You can answer these questions up front to not waste those downstream resources. So it is part of the process. There's no silver bullet. Anyone who's selling you a silver bullet, I would love to speak to them.
Yeah, and even myself being on the vendor side for all these years, I've heard from many a frustrated CEO to a new prospect who hasn't found alpha. We know it's in there. So, but to your point, both of you, Chris mentioned a client that asks about, okay, which data sets have the most alpha? It's kind of a rookie mistake. So that kind of rolls into my next question, because that's all we hear about, right? Like, what data sets have the alpha? So let's say I've found a great data set. I'm getting value. I'm getting alpha out of that data set. But now at some point, everyone figures out that's a great data set. And so more and more people start piling into it, right? And so I'm going to come to you, Elizabeth, with this next question, because we hear about it a lot. The decay of an alpha arbitrage and the speed of decay, is that increasing? Does the commoditization of a data set really matter? Does it just mean everyone else needs it now, or is that particularly harmful to my strategy? How do you think about alpha arbitrage?
Yeah, thank you, Christine. It's a great question. It's a big question. I think a way to start here is looking at the broader construct of what's happening. I mean, I think there's challenge on both sides of the equation. The data vendors, many more data sources, and how do you get those data sources to the quant who's developing the model? And then on the side of firms, that ability, like Chris was just talking about, that ability to be able to consume that data. And this is all happening in a construct that the breadth of data available continues to increase. And at the same time, data updates are speeding up. There's a lot more variety. There's more frequent updates. And it's pretty accepted that some data sets, they're providing fleeting advantage, right? As the more firms are leveraging it, it gets crowded out, the value gets arbed out. And I think this makes the case for firms to be much more agile, to develop the agility to find, evaluate, and extract value from data much, much more quickly, right? It used to be the case that alpha was calculated monthly and trades executed monthly. The world we're in now, right, is there's pressure to find alpha much faster. The data at the same time is updating much more frequently. The number of updates used to be, once a week. Credit card transactions, once every 24 hours. And we're starting to look at real-time data, look at IoT data. We're starting to see much more data flow streaming. So we're seeing real-time updates on news and events in the economy at both the macro and the company level. And the frequency of updates of alternative data sets, right? It's just increasing. And certainly the pandemic made it clear that it's super important to have an understanding of the now, what I call the nowcasting data, right? It's the impact of events happening right now at a granular level, and to find those events that they look new. How do we predict the path forward from these events, right? And so with the application of data science, this intelligence, it can be found in alternative data sets such as health, consumer transactions, market sentiment data. And some of these are noisier, messier data sets, which require much more data preparation expertise. And so with the use of more data sources, with firms developing this agility to consume data sources and the expanding application of AI, there's much more computational throughput and data processing required. So I think the net results is the firms, it's It's the speed race, but here it's the content race now, right? It's kind of the war for being able to find the alpha with the right amount of compute storage, the NLP expertise combined with the AI to deliver the improved outcomes. And the firms that have access to this scale of capability are the firms that are going to win. So I think this construct of what's happening kind of across the industry puts pressure on the data vendors and on the firms to develop the the capability to be able to consume the data faster. So, I think the firms that are winning are those firms that are able to consume the new data sets that have the alpha the fastest. And at the same time, the data vendors are getting really squeezed because they're seeing their commercial models disrupted.
Yeah, it sounds like so many things have to line up to make that work.
Right.
Marco, as a quant, you've looked at so many different data sets. Is alpha arbitrage something you think about, you worry about, or is it potentially a positive thing?
Elizabeth already made a couple of really good points. I think what's important to think about is that if someone's trying to sell you a signal, you should be very skeptical. It's unlikely that that's actually going to provide any juice because of that arbitrage. And more often than not, I think kind of with the advent of machine learning and the kind of statistical techniques, it's very easy to gravitate towards, okay, I'm going to try and predict price action. That's non-stationary. It's the most difficult thing to do. It's much more, you're a much better position for success if you were to try and predict or sensitize the drivers that ultimately drive returns. And the more complex the data set, I think the more likely you are to find additional insights that can drive your alpha. And an example, I think a very simple example would be something like a credit card data set. Like the simplest thing you can do is roll it up to revenue. And you can predict revenue with pretty high accuracy. But with the granular credit card data, you could actually run various sorts of clustering analyses, see how the demographic trends by location impact the organic growth of a company. And if the company launched a new business line, for example, you can kind of before disclosure see how that business line is trending. So the more complex the data set, the higher the kind of data science know-how necessary to eke out insights or alpha, because you can have data, but converting data to information is where the kind of skill is necessary. And even with that, I think it's important to understand the pervasiveness of that paradox of skill, which is that kind of as overall level of skill improves in the market and more money comes in, more competition comes in, it's harder to grind out excess returns. So even if you come up with a very sophisticated way of extracting alpha out of a particular data set, it's likely that someone has thought about it. And it's always kind of a cat and mouse chase. And I think it's important to think about, kind of that data set orthogonality. It's very likely that when you're looking at a new data set, if you were to kind of differently slice a data set that you already might have, you could extract a similar amount of data. So that orthogonality is also important to think about. So what I would say is, think about the use case. It's what is your use case? If you're a pure play quant, you're coming up with signals that you're back testing and the alphas can jump out of it. If you're more of a quantamental discretionary guy, in that sense, you might be looking more along the lines of insights. Is a particular data set likely to predict my driver that goes into the model that can inform my decision making, whether to buy or sell? And those are probably better approaches because fundamental drivers like EBITDA margins, returns on equity, returns on invested capital, those are likely stationary over the longer term. Those are much more attractive to tackle. But then again, it requires a bit more of a complex process.
Yeah, and I think it comes back to Chris's point earlier. It's all about focus. And you mentioned complex data sets. You have more of a chance of extracting excess returns out of that. But like Elizabeth said, that requires a really agile team that knows what they're doing, and not everyone's starting from that point. And that's why they need someone like a Chris, Elizabeth, Rob on their team that's looked at all the data sets, that knows that process really well. Kevin, love to get your take on this. I know you have an options focus, but any insights from where you sit on, how the commoditization of certain data sets will play out, whether that's positive or negative?
Just some great points already made by Elizabeth, Chris, and Marco, hitting the speed of it. So when we tackle it, bringing information out of the markets, the option markets and the equity markets as well, the process for us is starting out with can we extract value at the end of day level, and then it's a rapid progression forward, looking at moving to intraday information, intervals, getting to ultimately something along the lines of what Elizabeth was talking about, streaming data. Now, yes, you can dilute the value of the information. You can also spread it out to a bunch of users. So we also look at a race to get it to as many users as possible. The alpha can get arbed away rather quickly, but I think you can also establish it as, for lack of a better term, table stakes, that you've got to have this just to be in the game, and that creates the foundation for your next level of information. And what we started out with, I'll just take the example of vols and Greeks. That was a great addition to the options markets. Thank you, Fisher Black, Myron Scholes, hot on their heels. We had Cocktross, Rubenstein. So we've seen improvements there. We're still extracting information from those data points. We're looking at projecting implied earnings moves, predicted ranges for stocks, and when you see something jump outside of the expected range for the market, that's information. That's a value add, and it's a new way to use a data set that's been around for several years.
I think everyone's kind of touched on the technological side of things, and improvements in the speed of incorporating data is going to separate the winners from losers, and how agile your data science team is. And so that kind of brings us to our next topic about the cloud. How has the cloud changed things, especially the speed and cost of computing? Chris, I'll ask you, you no longer have to maintain data storage. That must be a huge plus.
I think one real key is that it's allowed new entrants to scale up quickly, right? So there's less of an investment up front if you can outsource a lot of this to an Amazon type of firm. So that's really the most exciting piece for me. I think one thing that I would advise to shy away from is there's firms who have tried like a hybrid cloud and non-cloud approach. That's necessary if you're a legacy firm and maybe you're transitioning certain data sets to the cloud, maybe some less sensitive data sets, or maybe you can do your research in the cloud and do your trading and on the ground, so to speak. But I think it's important to have an approach that makes sure everything is in sync. Not everything needs to be in the cloud, not everything needs to be on-prem, but you can put much more in the cloud than you think. And I don't think it's worth to try to store it twice in two places. There's a lot of interesting, so Amazon will charge you nothing to send them data, but once you download data out of their infrastructure, they charge you. So these are things that you only learn if you get that bill, right? It's kind of a bunch of mistakes that you make that give you the knowledge base along the way. So that's what I think. But beyond what cloud has done, yes, it's made everything cheaper and faster, and maybe firms have spent more. They've taken that and redeployed it into buying more data sets, hiring more people, automating more things. But the most exciting thing for me, I typically these days work with smaller, medium-sized emerging firms. It makes them much more nimble than some of these legacy shops who are, not that the legacy shops don't have the edge, because they have a running head start. Their plane is already in the air versus other ones who are still kind of building the runway, but it does make things more competitive quicker.
Yeah, it's interesting what you say about allowing the barrier to entry kind of falls. Little new entrants can get up to speed more quickly than they have in the past. Elizabeth, love to hear your take on how the cloud might be changing the game a bit.
Sure, yeah, I can offer a few points to tack on to what Chris has just said. So for firms that have their own prem, right, they're going to be moving from CapEx to an OpEx financial construct, and they're going to need to re-architect for the cloud. And so that all needs to be taken into account. It's not necessarily just a simple lift and shift. And in terms of the applicability or some of the advantages of cloud, let's say, is that yes, new firms can get spun up much more quickly. New data vendors or data vendors that have data sets that may be in a, kind of their own private data center, make those available in the cloud. It's much easier to make that data available to your customers for testing and then production purposes. And then also the impact on model building, right, is it's kind of you need a ton of data at the beginning. And so if we're talking about some of, the most value coming from data sets that are these super large, unstructured data sets, or even huge tick history data sets, time series data sets, you need a ton of data at the start to mine it and start to develop models and figure out where you're going to be getting the most impact. And then when you move into production, your data set is going to be smaller. So that ability to have more elastic storage and compute when you're developing out your your modeling, let's say, workflow straight from the data, you're going to have a lot more ability to design your let's say your tech stack, or how you're using very efficiently storage and compute. If you're, in, a brand new kind of cloud infrastructure versus perhaps some legacy infrastructure that you're on from your legacy tech stack. So for firms that are developing out their data science capabilities, developing that sandbox, research sandbox in the cloud provides much more freedom to experiment and work with very large data sets, but also manage the cost. And I guess the other point I would make is, especially with Snowflake coming online, firms that are creating new data infrastructure and they're leveraging the latest, it could be, solutions such as Snowflake, but the other cloud providers certainly have their competitive alternatives. It's much easier to be able to flick a switch and get access to that data set, get entitled to that data set and start making use of that data set much faster than if you're, needing to move data around from an FTP location, et cetera. So I think the cloud, as Chris was saying, provides more optionality, more capabilities to be agile than perhaps a legacy tech stack. But it's certainly not trivial moving from an on-prem or a legacy stack to the cloud. There's a lot of re-architecting and planning that goes into the new cloud model.
Great, thank you. That's all great information. Lastly, just to kind of close it out, I wanted to get everyone's 1 to 2 minute take on the future of alternative data. I know that's a huge question, but where do you think the space is going in the next 5 to 10 years, and what types of data do you think will be influential in finance? And maybe if there's certain data sets you're interested in right now. I know Chris had mentioned a couple, but Rob, I'll start off with you. What are you looking at?
So, I'm thinking 10 years from now, what is alternative now will be mainstream in 10 years. So, majority of what we're looking at now will be mainstream. I think it'll be more focused on country, European, Asian type of alternative data on a smaller scale, focusing on, not parking lot data, but on a smaller, individualized, company-based data. So again, I'm not sure. I really haven't put too much thought into this, but I can't say that what we're looking at now we will not be looking at 10 years from now.
Marco, anything from you? Any data sets you're looking at right now?
Well, first of all, to echo what Roberto said. I'm fully on board. I think it's what's alt data today is going to be mainstream likely. I might be a tad bit biased, but I think NLP is going to be play a pretty large role because so much of that data out there is unstructured text, and we're nowhere near this capability of properly translating that to human understanding. There are likely to be huge advances in that area, but I think ultimately those who are not participants in that space, kind of understanding how to fold that into their process, are going to fall behind. So I think it's here to stay, and I think the sophistication around that data mining and data analysis is going to get better and better. Cloud's going to get better and better, and processes are going to get more standardized. So I think ultimately the world is going to be the investing world is probably going to be very different in 10 years.
Kevin, your thoughts?
Oh, thank you. So yeah, I agree with Roberto that what's all today is probably going to be standard 10 years from now. Particular interest for me is in the ESG space. It's not just can you make alpha, but where is that alpha coming from? So I think ESG is going to be very important going forward. And I may be off the rails here, but I think crypto is going to be around, and we're even seeing ESG involved in crypto just recently. Kevin O'Leary came out basically saying, I'm interested in where my Bitcoins were mined. So he's committed to it already, but he also has he's already put it out there that he cares where those were actually mined, where they were made. So I expect both those areas to be very important going forward.
And Chris, you had mentioned some ETF data sets and other things you were looking at right now.
Well, yeah, I can get back to those, but I think consolidation will continue to be a driving force. You've got large firms acquiring really small firms. You have large firms like S&P acquiring enormous firms like IHS Markit, who just acquired an enormous firm, IHS, before that. So I think the larger firms are getting larger. Some of the smaller firms are, we'll call it, pivoting away when they run out of capital to raise, right? The ones who had success several years ago are continuing to have success now in the vendor space. And that's only driven even more by firms like this. When a bunch of people tend to like certain data sets, they don't get crowded, but these three vendors are more exciting than these three vendors. This one legacy vendor doesn't keep their data set point in time. They will have to either figure that out or get out of the business, right? I think regulations are going to play a big part over the next 10 years. So there's been a lot of rumblings, for example, about Apple has been changing every time they update their operating system, they're making it harder for firms to collect location data, to collect advertising data. Those are two big pieces of the alternative data business that Apple can essentially make a blind spot overnight. So whether they do it or the government tries to take a hand in it, I think that will play something certainly over the next 10 years. And I think lastly, around the stitching data sets together. So what Marco was touching upon earlier around maybe a data set doesn't have a ton of value by itself, but if you layer a few other data sets on top of it, that's where you get your differentiation. I think there is a very short craze in buy it in the morning, sell it at the close, these types of data sets. But you can do three things. You can listen, you can take the opposite, or you can ignore it. And the more raw or semi-structured the data is, the more you can do with it. And ETF data that I was saying earlier, there's kind of rebirths in these spaces. So ETF data, you consider it a pretty boring space, right? But you have newer entrants into the space, newer in the last few years, like an Ultimus, something like that, that would compete more with like an IHS Markit. IHS Markit is more, they've been around the longest. They acquired the largest vendor before them. And there's other firms who are coming up with, kind of fresher ways with the same type of data. So the legacy ones are being disrupted a bit. And there's always those newer entrants as well.
Elizabeth, we'll end with you. What are you expecting for the future of alternative data?
Yeah, so I agree with what's already been said. I think that we'll continue to see flows to scale, right? So the big will get bigger. And I think smaller shops that are not able to invest in or make use of new data for insights are going to drop out, or they're going to, so we'll have the big getting bigger, we'll have the small dropping out, and we'll have an emergent group of fundamental discretionary shops that will become more quant-like, and they'll start to leverage more data sources. And the way they'll do it is we'll have solved the aggregation problem that is bringing many more data sets to get insights about companies. We'll have what are called digital twins of companies of a company, of a portfolio of industries, driven by AI to extract the value, extract the risk, extract the insights. And these capabilities that will equip this emergent class of firms, I think will be obtained through subscriptions. And I did a whole talk about this, about portfolio managers being conductors, meaning they're going to need to be really good at finding the capabilities for the quant, the data management, the AI-driven insights, kind of software as a service subscription models, to be able to bring in the alternative data and the ESG scores and make sense of it in a very proficient way. So I see that happening in the future. There's going to be much more democratization of the capabilities across those who choose to adopt it.
Excellent. I think we're going to wrap it up there. Thank you again to everyone who participated and those of you listening. This concludes our presentation today. As I said earlier, we will not be having any Q&A, but we encourage you to book a one-on-one private consultation with any of the speakers you see here. I'm just going to throw up a screen so you can see who is participating. We have everyone here with a couple additions, our very own Mike Rains, and then Herb Blank from Global Finesse. I'm going to run through really quickly each of their topics, although I'm sure all of these folks would be happy to speak with you really about anything in the alternative data space. So Chris's topic is the Ask Me Anything Alternative Data Edition. So catch all any of your questions about alternative data. Elizabeth will be speaking about the foundational building blocks for incorporating alternative data into your investment strategy. Marco with incorporating quant strategies into your fundamental approach. Roberto, as we mentioned, very first question, the finding new and valid sources of data without wasting time. He can talk you through that a little more. Kevin will be speaking about opportunities with options. Herb, who I believe is only available tomorrow, but he'll be taking calls on the continuing evolution of ESG data and ratings. Like I said, our very own Mike Rains, our Director of Quant Data Solutions, will be talking about event clusters and how they affect volatility. So again, thank you to everyone, to our participants, and to everyone that's been listening in. We'll be sending out a link for you to book those one-on-ones, and we'll also be sending out this recording later on today. So thanks for joining us, and hope to see some of you at the one-on-ones later today and tomorrow. Take care.
Thank you.
Thank you.
Thanks, everyone.
Bye-bye.
Yeah.
Bye.